our accountants, John Murr and Lori Royer. Their bios are clearly in the materials and the agenda that we provided you. So instead of reading that, I'm just going to talk a little bit from the heart here. They are very good to us. They've been working as our accountants for about 5 years. They help Lisa and they help myself whenever we need it. They have a great understanding of PACD, and I think they have a really good understanding of the districts. We worked really hard with them over the last few months to put this presentation together. Lisa worked extremely hard on putting together the handout we have for you. Even just as early as this week, John Murr was up at, I believe, midnight working on the outline. So we definitely put in the effort. We hope that it's beneficial to you. We understand that the districts have different structures between county, independent, and all the variations in between. So we try to make it broad but effective. So you might not get something out of every second of this presentation, but we do hope that you'll come out of this with a better understanding. And the packets are there for you to bring home, to take notes, to be able to provide this to your board when at a next meeting or etc., so that hopefully some of the information that you're learning here at PACD can get back to your home district and hopefully make you a stronger board and make you more effective at conserving natural resources. So with that, I am going to turn the mic over to John and Lori, and I hope that this presentation is helpful. Thank you.
Okay, well, thank you for having us present these two topics for you. I just want to briefly go over how my section is laid out. In the green booklet, we have an outline, and each page has a section, and then there's an area for notes that you can make your notes, and we'll have a time at the end for questions and answers, because all the districts are so diverse and everybody's needs are so diverse. If I just try to tell everybody what I think they should need, it's not going to work for everybody. So we're going to basically highlight the important areas, and then we can get the specific questions that you can ask, and perhaps we can all learn from that. The second section is a more detailed area of the outline. And this has all the expanded topics of the outline that we're going to go over. And then the last section is under internal controls. What this is internal controls related to specific transaction classes. Now, specific transaction classes are different areas where internal controls need to be implemented, and this gives a very, very detailed outline of things that you should ask in your mind, well, should we be doing this? Maybe, maybe not. And like I said, every organization is going to be different because of the size and the diversity. To emphasize internal controls, I was reading I'm from Lancaster, so I was reading the Lancaster News last night, and I saw an article here that there was a fraud committed within the government in Philadelphia. There's people who you think that would be in a position of trust, public trust or corporate trust or any trust, but you see this every day. I mean, we see it in Lancaster. Someone I was talking to saw it in their region. It happens all the time. Now, why does this happen? Well, there's called a fraud triangle. There's the opportunity, the incentives, and the rationalization. The opportunity is, well, the internal controls aren't strong, so you have the opportunity to perpetrate. The incentive is, I need money. The rationalization is, I'm not paid enough. Is anybody here that's paid enough? Okay, so we all have that. But if you give a person the opportunity, and if they have the incentive, maybe they lost their job or their spouse lost their job and their house is going into foreclosure, people will do this. And you see it all the time. People in the news say, I'm sorry I did this, but I had no choice. So internal controls are very important. And what internal controls do is it mitigates the risk of theft or fraud within the organization. So with that, let's start at the outline. on page 1, this is the board's fiduciary responsibilities. The objective is to provide knowledge to assisting accounting managers and board members in understanding how to design and implement accounting systems and provide strong internal controls. And we're also going to discuss the structure and the role of the board of directors and what they need to be aware of. So organizations are all governed by a board or some governing body. It's called the governance. So for a board of directors, they have the ultimate responsibility. I mean, the buck stops here. This is where it ends. If anything happens in the organization, fraud or something doesn't go right, who's responsible? Well, it's the board members. The board needs to be aware of that, and the board has to have policies and procedures and knowledge to make sure that that doesn't happen. So all potential board members are potentially liable. If that organization gets into a lawsuit, you as a director, you are responsible, just as a corporate director is responsible for their corporation if they're indicted. So with knowing that, we join boards. Lori and myself, we're on several nonprofit boards to offer our expertise and give back to the community. And we always ask, do you have officers and directors liability insurance? Because that's a must, because we don't want to be personally liable. So that's very important. I don't know if everybody realizes that, but that's something you need to know. So what the board does is they provide the policy of the organization. They set policy and the goals, and then management, in turn, is supposed to carry out those directives. And a lot of times, the board gets too involved in the organization and doesn't leave it to the management itself. Unless, of course, you have a small organization that the board is the management. I'm on a board. It's a local nonprofit that provides entertainment in Lancaster. It's a summer park series that we do free concerts every week. So the board is very involved because there really isn't any employees. So the board does everything because it's all volunteers. But if you have an organization that is structured where the board meets and they present the policies, and you have a strong management staff and you rely on them to do their job, it's best not to meddle, so to speak. I mean, they have the expertise in the management, you set the policy, and that's the way it's usually structured. So what I'm going to do is I'm going to pause on each section here and take questions. Are there any questions related to that section so far? Okay, let's go on to the next one. Now, at board meetings, we take board minutes. What it does is it documents what was decided, the policies, the contracts, any litigation. You want to have a written record of it. And with government agencies, it becomes public record, and you usually have someone from the newspaper there, the attorney's there, and it all gets recorded. And that way, if you have to look back at it, later on, there's no question as far as what was discussed. So it's a public record. Some things you should write, and once again, this is an abbreviated list. In the rest of the details is an expanded list. You should indicate any new or additional support or revenue or reduced or terminated sources. So if you have a grant approved, you should document that in meetings. Or if you lost a contract, you should put that in the minutes. Acknowledge contributions and gifts. As the auditors, we read the board minutes, so I guess I shouldn't tell everybody this, but we learn a lot from the board minutes because there's a lot of things that go on that we don't know about that we aren't told. You know, we're required to ask questions of management. Is there anything going on? Are you aware of any fraud, theft, or anything? So sometimes they really don't tell us the whole story, but we can read it in the board minutes because they don't realize that we read it. So just be aware of that. Approval of agreements with funding sources and related budgets. The budget is prepared by management. And then the board of directors would approve the budget, and within government organizations it becomes law. So that gets written in the board minutes as far as that process. If you have a structure where you charge dues, fees, or rates, you want to have that in writing. Because if somebody thinks they might be charged wrong, a wrong fee or an old fee or being discriminated against, you want to be able to go back and say, no, this is our dues, fees, and it's documented in our board minutes. Debt agreements is an important one because you're acknowledging the liability and approving it for the debt repayment. Existing or pending lawsuits, that's very important because, as I said, everybody has the fiduciary responsibility and has the potential personal liability of any litigation. So you want everything that has to be associated with that lawsuit documented in your board minutes. Audits of funding sources and also audits of independent accountants such as myself. The board needs to discuss the reports, approve them, and have that documented. Identification of related party transactions. Now, a related party is a person who has some type of connection with the organization. It could be, if I serve on a board and I have a construction company and there's bids going out to renovate the facilities, it has to be documented that that construction contract, if awarded to my company, is based on a bidding process, and I didn't get an unfair or a inside agreement because I was associated with the organization and I got the inside track. You hear about that all the time. I guess they call that bribes and kickbacks, but it needs to be documented in the board minutes that this process was followed, because all you have to have is some concerned citizen, or what we have a lot of times is people from the newspaper who sit there and they look through board minutes because they're public record for governments, and they try to pick things up. An example was with Chris Christie. I mean, that event with the bridge happened in September, but it's only coming out now because it's on someone's agenda to bring it out now because they want to bring that to light for their personal gains or to destroy his career or whatever they're doing. Related parties should have a disclosure to the board. In fact, there's one board I'm on, I got an email last night, it's that time again. They said that attached is a related party questionnaire that we fill out and we sign and we send back if we have any personal relations with the organization, so it's disclosed and it's on record, so if anybody needs that. And as auditors, we ask that. Are there any related party transactions? Because that's important, because if there are, we want to look at those transactions to make sure it's fair treatment. A lot of times you hear stories about nepotism. In fact, the article in the paper was that there was someone they knew was a ghost employee. What the ghost employee is you have somebody on the payroll that doesn't work there. And if they're not filling out the proper documentation of name, social security number, copy of their driver's license, or some other type of ID in their personnel file, how are we going to know if that person works there or not? Now, if you have 5 people in the organization, obviously it's not going to be you're going to know who works there, but if you're in a large organization and 200 people work there and you don't recognize half of them, well, you're not going to recognize someone who doesn't work there. And then their paychecks will be sent to an address that somebody else is going to pick them up. So as auditors, what we do is we sample the list of employees and we look at the documentation for the records of how they were hired and everything they have. We look for copies of driver's license. Now, it's not foolproof, but the more you have, the harder it is to have a cover-up. But then again, also, you could also have more than one person involved, and that's where segregation of duties comes in to help mitigate this process. So once again, it's very important that the board documents everything they talk about Doesn't have to be in detail, but it should hit the highlights. So we all have short memories. I notice that the older I get, that I don't remember what I did yesterday half the time. It's good to go back to refer to. At the next meeting, you talk about something that was still open business, well, you kind of forget what we talked about. Well, we can go back and you can refer to that. That's always good to have, too. Are there any questions with anything that anybody thinks maybe should be included in board minutes or wants to emphasize what you do? Well, that should be documented also. If you vote on something, it should be recorded fors and against and abstentions. And you really don't have to address the reason why. It's just the fact that it was. So, I mean, you don't have to get in that much detail, but it is good to record the votes, how many for, how many against, and how many abstained. I don't think it's necessary. I think it's just basically the fact that you did record the fact that there was an abstention. I mean, if people have personal reasons, a lot of times it's because maybe they're on the committee or they're too close to it or they have somebody that's a related party transaction. They just want to stand back. As far as the people who vote against it, that would be in the discussion. You would know why they're against it because you would discuss it before you take a vote, yes. Fiduciary, fiscal, money. You have the fiduciary responsibility that you are at the top. You are in charge. You are the governance. It's your personal fiduciary responsibility, moral responsibility, money, morality. It's what you expect others to do if they were serving there. You want them to make the right decision. Errors and omissions insurance. Well, how much policy you should have, I guess it depends on the size of the organization and the size of the contracts and the risk. It depends on what you do. Everyone's going to be different, so I would suggest that you would contact your insurance company because obviously that, different levels you have, the more it's going to cost. It depends. $1 million. I mean, once again, you'd have to price it what the recommended amount was. But I think the important part is that the insurance that the organization has should be higher than the liability insurance you have. So, for instance, we have professional liability insurance as accountants. So if there's something goes wrong with the job, we get sued, and we have coverage. I think it's $1 million or around there. So I want to make sure that the board has at least $1 million because if we get sued, they're going to sue the one with the highest insurance, which would be them, I'd hope. Yes, people who handle the financial records, who handle money, who sign for checks, who approve the transaction for disbursement, the people who are actually physically handling the check that could actually physically embezzle the money, yes, they should be bonded. Usually it's people generally within the accounting department. Yes, the minutes should basically just be the framework and just say that you approve them. So if it's an annual process, it's part of that annual meeting where you approve that. The details of your rate changes would be in a separate document that's obviously going to be longer, especially if there's more than one level of fees. So once again, the board minutes should be the record of the actions, but the details can be contained somewhere else. Okay, your tree sale, is that a major fundraiser? Or, yeah. I would say that you want to document every fee rate schedule. If it's trees or fee for services or whatever, it should be documented. Now, for something like that, if it's just one level, we're going to charge $40 for trees, or so much per foot. That can just be updated. But if you have a long list of fee schedules based on different types of services and eligibility and income, that type of thing, you can just say that we have a new fee schedule. Then if anybody sees that in the minutes, they can ask for that. So it's just a reference point. Well, I guess the question is, if we have a separate committee and we discuss litigation, for example, does that need to be discussed in the board? Well, this is related to the board minutes, assuming that you only have a board. Some organizations have separate structures, and I have in my detail, you can have a finance committee, an executive committee, a planning committee. You can have a committee for anything. And what those people do is they get together and they meet, and then they present it to the board as their recommendation. For example, finance committee reviews the audit in detail with the auditors, and they make a recommendation to the board, and they say, we recommend the audit be approved, and that's it. For litigation, they would summarize it and report to the board. Okay, so it would be the executive committee, executive session of the board. Okay. Okay. So you'll have separate minutes? Okay, yeah. As long as you have separate minutes and you feel that for whatever reason, if it's a public meeting and you have the newspaper there and you don't want them to get this out right away, that you're working on something that hasn't been disclosed to the public yet, then yes, you would have that in your separate minutes in your executive session. Any other questions on this? Okay. Let's go on to the next section. Internal controls. Internal controls are a must. You have to have it. Because once again, if we don't have controls, just like if we don't have a government, it's a state of anarchy. There has to be some structure. There has to be a guideline, written procedures that everybody can refer to, everybody knows their job, and everybody can have someone else review their jobs to make sure they're doing their work. Just like we have job descriptions, this would be the same thing for internal controls. There's 4 broad categories of internal control. There's the control environment, and that's the attitudes and the awareness of the board. Everybody wants to have a positive attitude, we're going to do this right, and the board has to be aware that there's a possibility of fraud in every organization. And no matter how strong your internal controls are, there's always somebody thinking harder at a way they can circumvent the controls for their own personal gain. You see it all the time. Risk assessment. The board decides, based on our structure, where are the risks? Do we only have one person approving transactions and writing checks and reconciling bank statements and preparing the reports? Well, that's a risk. So you want to identify that risk. Information and communications, the accounting system, you want to have it detailed. If you have a simple accounting system, probably one person's going to have control that. If it's QuickBooks or a hand ledger or whatever, you're going to have one person doing the accounting. If you have a larger organization, you're going to have different departments for accounts payable, accounts receivable, federal programs, or whatever, payroll. But it should all be documented. And job descriptions, people within those departments, even if it's just a department of one, it's the bookkeeper, that person should have a job description of what they're responsible for. That way they can be held accountable for what they do. Because if you don't have a job description, you're wondering why something doesn't get done. You always hear the phrase, well, it's not my job. We all hear that, right? So this way it's documented what their job is, and they can be held accountable for it. So once again, the board sets the policies, and then management would monitor the policies and make sure people are following their job descriptions. It's not the board responsibility to go into the organization and walk up and down and check people's desks and ask them what they're doing. The board sets the policy. It's management's responsibility to manage to make sure people are doing their job. Monitoring Monthly reports, internal controls. You want to make sure that your accounting system is structured that the board is going to give, we're going to get information from management in the form of financial information when the board meets, that they can rely on that information. And if they have strong internal controls in place and they can rely on those controls, and the controls are not just processing the information, but it's also presenting reports. It's compiling information. What controls are there to make sure that donations are recorded to donations and not recorded to fee-for-service or government grants? So the monitoring is the board looks at those financial statements and you have a budget that you've now prepared or management's prepared and you've approved. Now you get your financial statements and you have 3 columns. You have actual, budget, and variance. Now there could be current year compared to last year. With the variances, you could have 4 columns. Whatever you decide to have is fine. A lot of times what happens is the Finance Committee, if you have one, reviews the more detailed information, the more expanded information, and then that's reviewed in detail because generally on a Finance Committee you have people who know more about numbers and what they're looking at. Whereas if you give that full report to the board, it's going to look like it's in a different language if you're not used to looking at that. So the board would get the condensed version that is recommended for approval by the Finance Committee. But if you don't have a Finance Committee and it goes to the board and the board looks at it, everybody needs to look at variances. You have to look at, why has this increased 200%, but this increased or decreased 100%. For example, payroll taxes should follow payroll. If you have more people working, the payroll taxes should go up. So if your payroll went up 100% and your payroll taxes went down 50%, you should ask the question why. Maybe health insurance was lumped into payroll taxes, and there's no right or wrong way of presenting it. It's whatever you decide is in your budget. You should follow the budget. If you put health insurance in payroll taxes, that's fine if you consider it a payroll tax. But if you want to see that separate, to compare it year to year, that's important to have it separate then. So maybe you got a new health insurance carrier, for example, January 1st of this year, people went out and they no longer rate people by prior experience, so some people's health insurance would go down. So maybe next year when we review the report, our benefits went down, but our payroll stayed the same. Well, you ask the question, why? Well, our health insurance went down. Oh, okay. That answers that question. It's items like that. Office supplies would normally stay the same. Same size office, you do the same thing. Now, if you see something in office supplies, all of a sudden it doubled, well, maybe you bought a computer and it was put in office supplies. Well, if it was budgeted in there, that's fine. But if you have a separate line item for technology, you want to make sure it's in the proper location. So, if you have strong internal controls in place, the people who are doing those jobs know where to code them, and they code them correctly. So you have a person who receives the invoice, they code it, it's a computer, it goes to computer expense. You have a person then who reviews the bill for payment. They approve it for payment. They also look at it to make sure it's coded properly. And then you have the, you get the disbursement that gets recorded then in your accounting system. So there you have a two-step process where you have 2 people looking at it, but people do make mistakes. So it does go to the board then, and the board is looking at the financial statements, and it's the final set of eyes to look at that information. So it's very important that you look for not necessarily dollar amounts, but look for different changes and anomalies. Under internal controls, why are they important? Segregation duties is number 1. At minimum, you should have more than 1 person involved in any specific area. Cash disbursements, the person who approves the bill for payment should not be writing the check. The person who writes the check should not be doing the bank reconciliation. for obvious reasons. And you see all the time in small organizations where you have a treasurer who does everything. They're a board member or an employee, even within the board. The treasurer shouldn't be doing everything. There should be other people involved in the organization. But most of the organizations I hear, I think you have employees, so you would have people to do this for you. So you would have people who would process, pay, and record. So three different processes. So segregation duties is number one. Now, segregation duties is not a cure-all. You could have two people doing a transaction, but they could be in cahoots with each other. So what do? You have a collusion. Well, maybe there should be three people involved. Well, now you get three people that sit down, drink coffee, and say, well, how can we do this? Now you have three people. But the more people you have, the harder it is to commit a fraud and to conceal it. Processing cash receipts, the person who does opens the mail. Now, cash receipts isn't just currency. Cash receipts is also checks. The same thing with cash disbursements. It's not just cash, it's currency. It's not just currency, it's checks. So you have people who open the mail. The person who opens the mail should get the deposit ready, right at the deposit slip. It should go to somebody else who goes to the bank and makes the deposit, and then somebody else will check that deposit slip back against the bank statement when it comes. Perhaps it's the person that does the bank reconciliation. So there you have three people. Maybe that's not cost effective in your organization, so you would only have two people. Cash disbursements, as I said before, you don't want to have the same person approving the bill. Also, filling out the requisition. I'm going to fill out a requisition. The invoice is going to come in. I'm going to approve it for payment. I'm going to write the check, and I'm going to reconcile the bank statement. What's to prevent them from, if they're out shopping for something at Home Depot for something for the office, and yeah, I want one of those, so they put it in there, and no one's going to notice. But if somebody else looks at that, I feel so. Yes. Now, an audit isn't a cure-all. What we do is we take what's called a shotgun approach, is where we sample, and we look at a lot of little transactions, different places. We assess risk in different areas. If you have internal controls that you have one person doing a lot of the functions, we look more in that area. So what we do is we do sampling, and based on statistical analysis, if we see something, then we start asking questions. And we also look at the comparisons from year to year to see if something went up. It's important. The audit function is important, but it's not a catch-all. I mean, you see it all the time in the paper with, Arthur Anderson. They're no longer because of their audit with Enron and all that. So, but it is what an audit does is it does put some fear in people's minds. We're getting audited, so the auditors are going to find this. 95% of the fraud in an organization is caught by the employees or someone in the organization. It's not caught by the auditors. It's the people who have that insight, the information every day. They see things coming over their desk and something sticks out. We had an organization that we audited that I got a phone call, hey, I think something's going on here. They show me an invoice that it was the director, the executive director, okay, and this is a church organization. So you would think that they have the fiduciary responsibility, the tone at the top. They would shop for supplies for the organization and their different locations. And what had happened is the person who was paying the bill, the accounts payable clerk, saw something on the bill that was for one of the locations and know that they didn't use that there. And she questioned it, called me. So I called the board president, and we discussed it, and it turned out to be deeper than that. It wasn't a lot here and there, it was a little bit here and there over the years. But it's something that we wouldn't know as auditors by looking at that. I don't know what they purchased for this location. I don't know what they have, but this person did. So it's very important that people be aware, and you do background checks on people. We do at our office criminal history checks. We get references, credit checks. You know, last thing we want is to hire an accountant for our firm that just claimed bankruptcy. You know, how does that look? Especially if it gets out in the public. It's public records. I know in a Lancaster paper once a month they print the bankruptcies for the month. Same thing with payroll. You know, you want to have a person who is, if you use an outside service or you use your own service inside, if you know QuickBooks, if that's what you decide to do, and we'll touch on QuickBooks here later in doing payroll, you have to decide, do I know enough about payroll to do this? Which we'll get into. Maybe you do, maybe you don't. Because if you do something wrong and you get on the IRS's list or the state's list, it's hard to get off because it's hard to get things resolved. So for payroll, you want to have a different person approving timesheets than there is calling in payroll and that type of thing. We had another organization that they called me. You know, we didn't see it because it was a June 30 year end and we had a calendar year. And they called me in January and says, I was reviewing W-2s. The executive director was reviewing W-2s, and I know this person doesn't make that much. Then it was found out, we looked into it, and they were calling themselves in bonuses. They gave themselves a raise. And they needed money, and they just gave themselves bonuses. That person had everything to do with payroll. They called it in, they got the checks, they distributed the payroll, and nobody caught it until the end when the W-2s were looked at. Same thing with grants. Now grants, some of the grants are federal and you have a lot more regulations as far as what you're supposed to do. Federal grants have their own set of internal controls that it's based on what grant you have. You have to comply with the contract and those types of things for compliance. And there's 14 different compliance requirements for federal grants. So problems associated with small organizations, like I said, it's limited staff. You don't have a lot of people. So you have to decide where best to use your efforts to make it as strong as possible. And if you do have auditors, ask them. You know, maybe they have some insight. And what I have done is I have a long laundry list, probably about 20 pages long, of all the different areas and different controls you can have. So perhaps you can take that back and digest that, and it'll be something you can review with your boards as, you know, we need to look at our controls. Because we're responsible. If something happens, we're held accountable. Our names go in the paper too. So you can look at those different transaction classes and suggested procedures and controls you can do to help minimize the risk of fraud. Some small organizations don't have a lot of people, so maybe the board member gets involved. Maybe the treasurer signs checks. I was on a board where I signed checks because there was one employee. Well, that one employee could do most things, but we don't want them signing checks. I looked at all the invoices, made sure they were for the organization, made sure it was the correct amount, the correct person, and then I signed the checks. So the board should get involved any way they can, either signing checks or approving bills or maybe reconciling the bank statements or anyhow. The board can step in. Are there any questions on that? Okay, so moving along, we have best management practices, cash versus accrual. A lot of people say, well, what's best? Well, generally accepted accounting principle says use the accrual basis. Now, governments, they use GASB, which is a little bit different, but cash versus accrual, you might say, well, there's cash, modified cash, accrual, modified accrual. Basically, there's cash and accrual. Modified cash is cash, which means you do everything on a cash basis and you have something that's maybe not. Like, for instance, you have your fixed assets recorded on the books. Modified accrual is basically the same as modified cash. It's just what's modified to the extent. So if you're filing mostly accrual and you have one departure, it'll be disclosed in the audit report that you have a departure from GAAP, so it's modified. So if you have cash, which means your income is your cash receipts, and your disbursements are your cash disbursements. That's your expenses. But if there's a departure from that, it becomes modified cash. So in essence, there's cash and there's accrual. The modifications is just a subcategory. So what's best? Well, it depends what you want and what's required too. Some organizations have to report on the accrual basis because that's what's required by a grant contract. And we do issue audit reports on the cash basis, but we just basically say it's in accordance with an other comprehensive basis of accounting. It's acceptable. It's not bad to have it. It's all what's required. Accrual basis takes more effort because what you're doing is you're matching your income with your expenses. So if you have revenue and you bill at the end of June for June's revenue and you receive it in July, you want to record that revenue in the period you conducted those services and that revenue belongs to. Same with expenses. After the end of June, assuming you have June 30 year end, you have your bills that come in that relate to June. Utilities or supplies or whatever. You show them as an accounts payable and you record that expense in that period where it was incurred. So what accrual does is it matches your revenue when it was earned, regardless of when it was received, to the expenses for that period, regardless of when it was paid. Now, some organizations keep their books on the cash basis during the year, and then at the end of the year, the auditors go in and we get a list of accounts payable and accounts receivable, and then we record them. So it's cash during the year converted to accrual at the end. That seems to be a very popular way of doing it because to have accrual basis all the time requires a lot of work. What happens is you have to have a more knowledgeable person to carry out that function because you have to look at the invoice and say, well, what period is this for? I'm getting this here. The invoice is dated July 1st. Well, it's a July invoice, but you have to look to see what it was for. If it was something that they provided a service for in June, it's actually June. Now you might say, well, what if it's an invoice that covers 2 months? Now I have an invoice that has June expenses in it in July, and I get the bill July 15th. What period do I put it in? So, especially, for instance, like a phone bill, where you have charges for calls different times, are you going to sit down there and go through and add up all the calls for each month and put them in the proper month? I'd say no. I'd say pick a cutoff. If you're going to take July's phone bill, put it in June, but do the same each year. So you have 12 months in each. Be consistent. Double entry accounting system is basically debits and credits. And for every action, there's an equal and opposite reaction. Quote Einstein. So it's less likely you make a mistake because if you make a mistake, it's not going to balance. So if you have an entry here, there has to be an equal entry here. A single entry accounting system is like your checkbook register. Has anybody made a mistake adding in your checkbook? We don't catch it until you balance your checkbook, your reconciliation of your statement, and then you find out sometimes you don't. You just say, "Oh, the bank's right." So a double entry is an intention to catch the error right then. For instance, in QuickBooks, you can't post a journal entry that's out of balance. It won't let you. It's double entry. Records, you should keep all kinds of records. There's a record retention schedule. Most of the things should be kept for 7 years. Some things permanent, for instance, mortgages, deeds, those types of things. If you're looking at contracts, how long to keep them, it all depends on how long you're subject to audit. If they can go back 3 years. For our single audits we do, for government audits, we have to keep them for 7 years. Bank reconciliations, do I need to do that? Yes, you do. There's too many audits we go into that the bank reconciliation hasn't been done for 6 months. Well, right there we have an audit finding. We have an internal control issue. If you haven't reconciled your bank statement in 6 months, how reliable is your financial information? You don't know. It could be. It depends how far it's off and what it affects. Error corrections and audit trails. As I said, that the board looks at the financial statements, and they're the last set of eyes looking at it. It goes through the whole process, the accounting system, management, the board looks at it. It's the last set of eyes that looks at it. Somewhere along the line, somebody's going to see something that sticks out, and those errors should be corrected, especially before it's submitted to funding sources. An audit trail, if you find errors, something needs to be corrected, something was coded wrong in your accounting system, and you're using electronic accounting systems such as QuickBooks or something called Audit Trail, which Lori will get into, that you can go, we can go as auditors too, and with that Audit Trails turned on, we can look at the correction history. We can see what was corrected. Maybe something was approved and 5 people looked at it and it was recorded here, and everybody's happy with that. But then somebody went in there and moved it, and nobody approved it. Journal entries should be approved too. Not just payments for invoices being paid. Journal entries need to be approved, because you can have all the controls in the world to make sure something is recorded properly, but somebody can say, well, I'm going to move that, and they take it off the books. The QuickBooks Audit Trail will show that. It will show that entry's been made. You know, they said we used to use ledger books where you write in pen. You don't write in pencil because pencil can be erased. Same thing with QuickBooks. You have the audit trail, that's your pen. Disaster management, how should I prepare? You need to back up your computer system. Computers fail. It happens all the time. It's happened in our office. It's happened in our clients' offices. If you don't have a disaster management system for your data, you're asking for trouble. There's viruses that can affect your system and shut you down. If you have a backup, it should be done nightly, and it should be taken off site in case you have a fire. If the building burns down, there goes your backup too. Any questions? So this section we really pretty much already went over. That you want to keep the financial information short and to the point. You don't want to overwhelm people. Sometimes more is too much. Everybody has their own different level of expertise. And as board members, as we try to recruit people on the board that has expertise in certain areas. A lot of times CPAs serve on boards. I think I'm on 4 or 5 of them right now, and guess who's the treasurer? So it's my job to look at the information, decipher it, and I present it to the board in a language that they can understand. I don't talk accounting talk. It goes over their head. Because I understand there's people who have different professions, and they have different ways of looking at things, and they have no clue what's going on. They don't even balance their own checkbooks. You want to keep it short and to the point. You have basic balance sheets and income statements. And the income statement could be, like I said, actual compared to budget and a variance. It could be compressed. So if you have different areas, for instance, operating, personnel, development, you could have just one line, and that might be fine. But the Finance Committee, you might want to break that out through an expanded report and show all the different lines in there to see where a variance might be. That's the job of the Finance Committee or management to do, is look for those little variances. And once everything is organized, they can collapse it, and the board gets a summary report, which is more meaningful to them because it's less to understand. And then if there's any questions, they can be asked and they can be answered by the person presenting the report. And also that the treasurer or the accountant that presents that report can have notes. If there are variances, put a handwritten note on it or a typed note and present that with the report, because you know that question is going to be asked. Why is there a variance here? It could be a timing. This bill wasn't paid yet. Last year it was paid in June. This year it was paid in July because we didn't do this or for whatever reason. So the treasurer or the management who prepares the report to present to the board should have those explanatory notes. And in our audit reports, we have footnotes to explain things. We don't just have the financial statements. We have footnotes that show we may have a detailed list of deferred revenue, accounts receivable, an aging schedule that shows which ones are over 30 days, 60, 90, and ones that are over 120. The question might be, well, are these bad debts? So, but before it gets to that point, management would have to answer that question. Any questions on this section? Budgeting is important. What the budget does is it sets the framework of what you intend to accomplish. And the budget should be prepared by the people who are involved with that. Management doesn't do the budget because, once again, management is a couple steps removed. They're not going to know all the details. So management would prepare the budget, and a good place to start is the prior year actual. You take that and say, what's going to be different this year, or what's going to be different next year? And then make the modifications and have it as detailed as possible. You would have a committee, finance committee, or a budget committee, or something like that, to hash this out, meet with staff, get it all detailed, then present to the board. The board approves it because it's in the minutes. You review it monthly, there's variances, and everybody knows what to expect. But budgets aren't rigid. Budgets will change. And everybody should be aware of that just because you have a budget that we approve, we must stick to it for the whole year. Things change. You add programs, you lose programs, something changes. You should have what's called a flexible budget. The budget should be reviewed. You might have to reclassify some things because items you planned on didn't happen. So the finance committee or management would meet. It would be modified. The board would look at it, it would approve it, and sometimes, depending on your contract, you need to have your funding sources submitted to them. It has to be approved by them too. Multiple funding streams. If you want to create a master budget, you should do it by funding stream. So you take the sum of the parts and add them together to make the whole budget. You don't start at the top and work down, because if you do that, you have, for instance, manager's salary. We're going to allocate this here, this part to that one. Now what happens is you've allocated that person's salary 125%. You can't do that. You take the pieces and you add them up to get the total budget. And the budgets could be separate too. You can have a capital expenditure budget, an operating budget, a plant budget, or whatever you decide to have in your organization. As far as analyzing the results, we looked at that. We talked about that. You want to look at variances. That's the most important thing. How does it compare budget versus actual, and also how does this year compare to last year, especially if the budget's the same as it was last year. And timeliness is the key. It doesn't make sense to review your actual report 6 months after the date. Now, the audited financial statements, because there's a lot of information, always comes out 6 months after the year end. Don't rely on that. You want timely results so you can make timely decisions to make corrective actions to move forward. Your board meetings should be scheduled at a time where management has time to prepare the financial information for the most recent month. For example, if you have the closeout at the end of the month, and then you have your board meeting on the 15th of the next month, that's 2 weeks to prepare that. The board can make a decision. Any corrective action plan can be taken immediately. But if you have information that for some reason your accounting staff hasn't gotten to it, and your budget versus actual and financial statements are 3 months late, it's not as useful. You find something that happened 3 months ago, and now you've lost 3 months to make a correction, and it's just not worth it. Is there any questions on that? Yes. What not to include in the budget? Things that you should not include in the budget are things that are not relevant to you or important. Something that doesn't apply to you. So if you have a template budget and it has to include something you don't have, obviously you don't include that. But the big item is miscellaneous. You don't want to budget a large miscellaneous expense because that becomes a catch-all. So if you have all your expenses listed and you say, well, we'll have other or miscellaneous, those are two items that you want to budget a small amount so it's budgeted so you can charge things there, but you don't want it to be a garbage can, so to speak, of everything that, well, I don't know where this quite fits, so we're just going to stick it in other. So those are two examples of things not to budget. How far to receive the financial statement before the board meeting? Well, it depends. on the complexity of it. More complex statements are going to need to be reviewed, a couple days. I feel that if it's a day before, usually it's sent up by email, that should be enough time. But once again, it depends on people's schedules too. Because sometimes if you send it out too soon, people look at it and then a week goes by and it's not really fresh in their mind anymore. So I would say as close as possible to the board meeting, but not too far. You want to give people enough time to digest it. I'd say a day. They should, if you have a finance committee. So the finance committee would meet first, and then the board is usually scheduled normally a week after. So there would be a month end. The finance committee might meet on the 10th. They would review the financial information from the last month, review it. If there's no corrections, it would go to the board meeting the next week on the 15th, say, and then it would be presented and it would be briefly reviewed, okay, and then approved by the board. So the finance committee would say, we reviewed it last week, we have these items to stress and emphasize, and we suggest it be approved. Well, multiple fiscal years is a problem for budgeting and for presenting reports. Now, QuickBooks does have a nice feature called classes where you can classify them and you can report them separately so it doesn't matter when they close out. And the budgeting process for those separate grants, you should have a separate budget for each grant. But once again, if you do that and they're on different fiscal years, you have to make sure you don't over-allocate something. For example, salaries. You still have to look at it on an annual basis as well as the fiscal year basis to make sure you don't allocate it. Does that answer your question? Yeah, we can do that. We'll have that with QuickBooks at the next session. And Lori and I will be here. We'll be here through lunch and a little bit after lunch to answer any questions. Feel free to come up and talk to us on your individual basis. We have our contact information. We have business cards. Because I know that this is a lot of information to digest, and it's really an all-day topic because there's a lot involved here. So I just tried to touch on the basics, which would be the board's responsibility to set the tone and the structure and have the proper internal controls, because nobody wants their name in the paper, like that person I showed from Philadelphia in the beginning. I think we're getting to the end here. Payroll, once again, should you be doing it? Maybe you want to save some money. Do you have the time? Do you have the expertise? There's a lot involved with payroll. Payroll is constantly changing. The laws are changing. The rates are changing. If you're using the wrong rates, you're not recording the information right. You're not making your payroll deposits timely. You get charged penalties, interest. Is it worth it? Is it worth the extra cost to save a couple dollars now, or just subcontract it out to a payroll service, ADP, ABC, whoever, Paychecks, whatever you have in your area? And what if I mess up? Well, good luck with that. You start getting notices and you have no idea what they're talking about because they're computer generated, and you have no idea what you did or how to fix it, or even how to get out of the notice. There's an amnesty program that they passed a few years ago that if this is your first time penalty, you can write a letter and quote this section, and more than likely than not, they're going to bait that penalty the first time. But that's just once. After that, they can be very expensive because it's based on, if you're a large organization, you miss your payroll deposit by one day, it could be very expensive because it's based on the payroll. So if you mess up and you don't understand, and you have a CPA and auditor, I suggest that you get that to them right away. We get them all the time, and we help our clients out because we know exactly what to do. We know the process. More than likely, we'll get a power of attorney or you sign a document that says that we can represent you for this issue. We will write letters, make phone calls, and try to get your best resolution. And come to our QuickBooks session, which is going to start 2 minutes ago. I'm just cutting into Lori's time a little bit, you know. Yeah, so.